Hi everyone, my name is Marcella and today I will talk about accounting regulations and ethics. I will briefly introduce the term ethics in the accounting industry, and I will talk about some of the ethical dilemmas that managers and accountants confront in their daily work. I will also talk about some of the corporate accounting scandals that has happened due to unethical behavior and choices from accountants and managers. And I will talk about what is considered accounting fraud. I will also talk about the laws and regulations that have been enacted in place in order to protect investors and workers from the side effects of unethical choices. Now, what are ethics? Ethics are a set of moral principles or values. Ethics deals with the moral quality, fitness, or propriety of course of action that can injure or benefit people. Everyone has such a set of values, whether or not we have considered them explicitly. Now, in the accounting profession, society has a very high expectations for accountants regarding ethical behavior. Accountants handle a wide range of privileged and sensitive data in their daily tasks. And because they work with numbers that can have repercussions on bonuses and stock prices, they're often faced with ethical decisions. Accountants play the unique role of monitoring. They're responsible for making sure that firms report their finances clearly and according to recognized standards. Having some strong ethical values is extremely important. Ethics are sort of a gray area. Oftentimes, there's no simple right or wrong answer. Choosing to be ethical is something that you have to decide for yourself. Many companies have codes of ethics, and there are other professional guides, such as the Code of Professional Conduct for the American Institute of Certified Public Accountants. However, these guides cannot cover every potential ethical situation. Often they contain very broad statements that gives a general idea of ethical behavior without going into specific. They're meant to be a foundation. Now, what are some of the ethical dilemmas that managers and accountants confront in their workplace? Well, ethical dilemmas begin at and further evolve when accountants and managers begin with small compromises that may seem harmless at the time to bring out to the light or to take whatever action is appropriate. An accountant, for instance, might feel pressured by management to manipulate the figures or to leave things out of the balance sheet to make the company look financially healthy and stable. Now, blowing the whistle as an accountant sometimes is hard, and it's hard to know when to cross the line. Whistleblowing is defined as disclosing questionable practices involving the organization or its members. It may either be internal or external. Now, also, the SEC, which stands for Securities Exchange Commissions, has its own laws that protects whistleblowers because according to the National Business Survey, more than 1 of 5 who blew the whistle experienced some form of retaliation, which can be discouraging for people to do the right thing. The dilemma facing these accountants is whether or not they should call attention to the wrongdoing. Some people consider whistleblowing as a moral and professional imperative, while others are against it because it adverse effects on the company that they work for and can also can cause a firm to shut down, otherwise leaving tons of people without a job. Now, there has been several accounting scandals that prompted government regulation laws. Some of these scandals, and I'm sure you have heard of them, is Enron, WorldCom, the Lehman Brothers Holding Company, General Electrics, and many more. Now, let's talk about the Enron scandal. What happened in the Enron scandal? So, the shareholders of this Houston-based commodities, energy, and service corporation lost about 74 billions. Now, thousands of employees and investors lost their retirement accounts, and many lost their jobs due to some unethical actions of the CEO. What they did is that they kept huge debt off the balance sheets, but eventually got caught by an internal whistleblower. The interesting thing is that this company had been considered the most innovative for the past 6 years before they got caught. Now, the Lehman Brothers scandal, which happened in 2008, was a financial service firm that hid over 50 billions in loans by disguising them as sales. They allegedly sold toxic assets to the Cayman Islands banks with the understanding that they would be bought back eventually, which created the impression that they had 50 billion more cash and 50 billion less in toxic assets. That what they really did have. So they didn't get caught, but they were forced into the largest bankruptcy in the US history. Now, the SEC didn't prosecute them due to lack of evidence. And just like the other firm, it was ranked number one, the number one security firm by Fortune magazine prior years. Now, let's talk about laws and regulations. Given the vast scale of recent accounting scandals and their devastating effects on workers and investors, it's no surprising that the government and the public assume that the underlying problems are corruption and criminality, unethical accountants falsifying numbers to protect equally unethical clients. It is difficult to think that good things can come out of the scandal, but as a result of such scandals, companies are now forced to have a better control of their accounting policies and make financial information more reliable. For example, the SOX Act has increased government regulations in the public sector with the purpose of increasing investor confidence. Now, the GAAP was created to protect companies, investors, and other stakeholders, especially since the accounting practices of business can sometimes be questionable. These general accounting principles help hold companies responsible for their financial reporting activities. GAAP, which stands for General Accepted Accounting Principles, is meant to ensure a minimum level of consistency in a company's financial statements. Companies must follow the GAAP guidelines. Now, although these principles work to improve the transparency in financial statements, they do not provide any guarantee that a company's financial statements are free from errors or omissions that are intended to mislead investors. There's plenty of room within these guidelines for unscrupulous accountants to distort figures. So even when a company uses such guidelines, you will still need to scrutinize its financial statements to really know what's going on. Now, let's move on to the next slide. The Sarbanes-Oxley Act of 2002 was enacted to protect investors by improving the accuracy and reliability of corporate disclosures made pursuant to the securities laws and for other purposes. On July 30, at a ceremony in the East Room of the White House attended by congressional leaders of both parties. President George Bush signed into law the Sarbanes-Oxley Act of 2002 addressing corporate accountability, a response to recent financial scandals that had begun to undermine citizens' confidence in the U.S. business. The wide-ranging act flew through the House of Representatives and Senate in record time and passed in both chambers by overwhelming majorities. The act places new legal constraints on executives and gives expanded protection to whistleblowers. Perhaps most important, though, it puts the accounting industry under tightened federal oversight. It creates a regulatory board with broad powers to punish corruption, to monitor accounting firms, and it establishes stiff criminal penalties, including long jail terms for accounting fraud. The era of low standards and false profits is over, as Bush proclaimed at that act. Now, the SEC was created during the Great Depression with the passage of the Securities Exchange Act of 1934, which was designed to bolster confidence in capital markets by providing investors with reliable information and by requiring that individuals and corporations deal with each other honestly. The SEC established its whistleblower program in 2010 to give people greater incentives to report high-quality tips to enable the commission to detect wrongdoing and better protect investors in today's marketplace. Now, those examples that I talked about, like WorldCom, Enron, those are extreme examples of companies who cook the books. They are the few bad apples that get all the headlines. Most companies are run by ethical people. They may bend the rules, and many of them often alter the figures. But few take the process to the extreme, like Enron or WorldCom or the Lehman Brothers. Companies that claim billions in assets but promptly were bankrupt when their false claims were exposed. If every company used fraudulent accounting and chose unethical choices in their daily tasks, then Wall Street would be empty and there would be no markets. So I hope you guys liked the presentations. Have a good day.